What is up, everyone? Welcome to the first official video of the Bear Report. Today, we're going to be talking about a company that's caught in the AI hype, and that's Palantir Technologies. But before we get into it, do me a favor and give us a subscribe to stay up to date with any of our future content, and don't forget to like the video. The first thing I want to talk about is dilution, and many of the bulls out there have really tried to debunk this, and it's good information, but I don't think they really understand the consequences of what has happened. And then we're going to get into management, very, very complex things about insider selling with the company. And then we're going to go into the core business where we believe that this adds up to minor or major problems internally. So first off, we're going to take an in-depth look at dilution. So what you're looking at here is the 10K from 2022. I pulled this up because it has the stock-based compensation, which is what we're looking at right now before we get to dilution itself. But it has 2020 through 2022 stock-based compensation year over year. So it's just a very good visual to look at. Here in 2020, Palantir stock-based compensation was just over $1.2 billion. Now that's just unfathomable. And then for 2020, as you see here, it's 116%. Okay. And then for 2021, it went down. There's a downward trend. That's good, but it's really not good. This is still an enormous number. So 2021 was 50%. It's a decline, but still not good. And then 2022 was 29%. Just over $500 million. And if you go over to the general rule of thumb over here, which I have, this gives you a general idea of the percentage of stock-based compensation for companies. Anything below 1%, that's considered, that's great. Between 1 and 3%, that's acceptable. And then 3 to 5%, that you're getting a little bit too high. And then anything above 5% is just not good. And then we have down here is the latest Q3 2023 earnings result. And you can see the stock-based compensation down here. It is going downward, okay? I think we all know that. It went down to 21%. It's still very, very high. The byproduct of this is dilution. From IPO until current today, management has made some horrible decisions with their stock-based compensation, and this directly impacts long-term shareholders, something I don't think most bulls truly understand. The byproduct is dilution, heavy, heavy dilution. And I have a general rule of thumb up here for dilution. Anything less than 5%, that's kind of standard, minimal for tech companies. And then between 5 and 10%, it's getting pretty high. And then anything above 10%, that's just not good. If you see down here, 2020 to 2021, and again, this is the 10K for 2022, and it just has a chronologically from year over year, so it's an easy visual to look at. From 2020 to 2021 was 96%, almost 100% increase in the outstanding float. That's horrible. And then, like I said, it's going a downward trend, 7%. It's still high. And in Q3, actually, which we're about to look at, it went back up. But this is the issue here. The damage was already done when the outstanding float increased 100%, almost 100%. The bulls say, well, the stock-based compensation, we're poaching the greatest talent in the world. We're poaching people from Google, Microsoft, top tech companies, the best talent in the world. I just don't see how this business model is sustainable by diluting shareholders into oblivion. Again, the long-term consequences directly impact long-term shareholders. So this is Palantir's most recent Q3 2023 earnings report. If you look down here, it increased 11% year over year. And again, the general rule of thumb, anything above 10% for tech high growth, not good. So here's the bottom line. Management has hinted at cooling off with stock-based compensation, but cooling off to them is still above the average to most companies because that's part of their business model right now is to get the best talent in the world on their team. And as they scale, they're going to continue to hand the stock-based compensation out at a rapid rate. And in return, you're going to get dilution at a rapid rate. So it's gotten to a point now where Palantir is already so liquid that they're going to have to scale the hell out of their brand, out of their product, to get extremely liquid. because that's the only way long-term shareholders are going to get those significant returns. And by significant, I mean market-beating returns. So the question is, how much bigger can this company get? So here I have a little math demonstration just to get a perspective of what Palantir is going to have to do and how big the company is going to get if if it's going to 5 times, 10 times, or 25 times in the next decade or 20 years, whatever it is, that time frame. So right here we have Palantir Technologies. We're going to use 2.3 billion shares even for this. It's actually a little bit above 2.3 billion shares. And it actually says 2.1, just over 2.1 billion basic on the financial statement, but we're using 2.3 billion because this is what the financial analysts and institutional investors use for forecasting future earnings and valuing the company. It's a more conservative and comprehensive view of the company's equity, accounting for all the possible shares that could be issued if options, warrants, and the convertible bonds and other securities were to be converted to common stock. And then price per share has been fluctuating between $16 and $18, but we're going to use $17 down here as the median price per share. And then the current market cap has been fluctuating between 35 billion and 40 billion. How this works is for the company to 5 times at $17 a share, what you do is you take $17, 17 times 5, you get that number, whatever that number is, times the outstanding float, and then you get the market cap of the company. So if it's going to 5 times at $17 a share, this is going to be almost a $200 billion company. I mean, that's massive. Then if it's going to 10 times, again, 10 times 17, then that number you get, you times it by 2.3 billion. This is how big the company is going to get. Almost 400 billion. Then if you do 25 times, I mean, you're going to be competing with Amazon. Then 50 times, you're bigger than Microsoft. And then 100 times, you're the largest company in the world. This is the thing I don't think bulls understand. Dilution is not going to stop. If stock-based compensation is part of their business model, where they are going to recruit top talent, because as they scale, like bulls believe they will, they are going to continue to give out stock-based compensation since headcount will increase rapidly. In return, shareholders will continue to be diluted at an unsustainable pace. We will get into this later in the video, but we need to know how much, realistically, bigger can this company get. Many companies love to throw out exaggerated numbers when it comes to their total addressable market. And many have said Palantir's total addressable market is in the arena between 800 billion and 1 trillion. I mean, that's a big number. And management has given no clear and concise approach on how to tackle market share or even highlighted on how much they have now. There is no simple transparency with this company, especially when management's words heavily don't align with their actions when you look at insider ownership. But ultimately, this dilution right now should be looked at like anti-revenue growth. So in this next slide, in Q2 of 2023, Palantir decided to announce a $1 billion buyback program. This is a move in the right direction and should be a relief to long-term investors that they may be pivoting their focus to addressing this dilution problem. But again, if the company is going to continue to dilute, it really does not have a material impact on the company with the rate that they're giving out stock-based compensation and dilution following that. And this adds up to what the ultimate bear thesis is going to be, that this leads to problems going on internally or, unfortunately, something bigger. This illustration is from 2021. I know this may be outdated, but wanted to give everyone a perspective of how inflated their stock-based compensation was during this period in comparison to its peers. This time period specifically, because this is when most of the damage was done. So this is the last 12 months of stock-based compensation to percentage of revenue. And these are all SaaS companies. Okay. So you got Adobe, Shopify over here. And then when you get in the middle, you have DocuSign, ServiceNow. And then when you get over here, you get MongoDB, Unity, Okta. And then as farther left you go, the higher percentage it is. And then you have Snowflake, which is notorious for stock-based compensation and dilution. Then you have Palantir, which sticks out like a sore thumb. 114%. Now, this is from 2021. So this is when the damage was already done, like I said, between 2020 and 2021. And they continued to dilute shareholders. Next thing I want to talk about is management. And this is where we get into the complex stuff with insider selling. So right here, I just want to throw this out here. The Chief Accounting Officer, resignation, Jeffrey Buckley. Now, usually resignations are, it's not that big. I don't want to say it's not that big of a deal, but it's kind of concerning depending on the time it's done and how they leave, okay? So I don't want to call this a red flag, but it's a yellow flag in the sense of how he decided to leave right before at profitability. And him leaving the company supposedly the greatest AI play for this decade, the most innovative and revolutionary artificial intelligence product out there. There was no description or any color on why Jeffrey Buckley wanted to leave, especially right before they get profitability. It makes no sense. Why would you want to leave this great company that's going to scale to a $1 trillion company and they're just profitable? Why would you want to leave that business? And a lot of the financial institutions called it, unusual, concerning. And that's exactly how I think investors should look at it, because it is. I mean, why? There was no explanation for it. So I kind of want to give this a yellow flag. I just want to get this before we get into before we get to the insider selling. I wanted to go over this because this is kind of overlooked. So here we go. Alexander Karp, the co-founder, CEO, and director. So when the stock first IPO'd, he had over 20 million shares. Today, as of the last transaction date, he ended with 6.4 million shares. And this is Class A common stock. Now, Palantir has two other classifications which they use, and that's Class B and F. I don't have either labeled, but I will show a visual of what Mr. Karp and the management team has been doing with their Class B stock as well. But he sold 14 million shares from IPO to the current date, last transaction, which was November 21st. Most of it was at all-time highs around IPO levels. Now, many will say, well, if you had a significant stake in a company, then reached all-time highs, you would sell some of your position too. In this context, I strongly disagree. If your brand is going to revolutionize the business world, or society for that matter, and you have a vision of being the next trillion-dollar company, you don't dump over 50% of your direct ownership, especially at the most concerning time period, which raised eyebrows at all-time highs and IPO boom levels. But for the cherry on top, I'll show you why this is a much bigger deal than many think. So in this graph, this is a graph of Alex Karp directly for direct ownership, directly buying shares and selling shares in the open market. Yes, buying and selling. And as you can see, there is only selling, and that was all done at IPO and all-time highs. The bulk of it was done. There are no buying at all since IPO. It's cut off here, but this is IPO down here. Till today, nothing. Has never bought a single share since, even at these lows down here, before they hit profitability. Nobody was buying. And what is not listed is the Class B common stock that Alexander Karp also owns. What he has been doing consistently for months, all the way up to now, today, he's been converting Class B stock to Class A and selling that. And up here, this was over 50% of his stake. Now, today, Alex Karp has just 3% ownership of direct ownership of the company. So 6.43 million, like last slide I showed you, that's how much he has today in the last transaction, November 21st. So now what we are looking at is the entire management team from IPO until current, including Jeffrey Buckley. This is a graph of buying and selling directly on the market. As you can see, there is not one person from this management team that has bought, even at their lows when profitability was inevitable. Also, most of the selling was done when the company raised capital after IPO and all-time highs, and no buying since they have been public. Then this is the insider momentum for the last 12 months. You can't make this up. 61 transactions for selling $120 million. 61 transactions in the last 12 months. You go over here, this is buying. 0 transactions for the last 12 months. Why? And I put this over here, this Peter Lynch quote. I'm not a Peter Lynch fanboy, but he makes a lot of sense, and I agree with this completely. Insiders might sell their shares for any number of reasons, but they buy them for only one. They think the price will rise. But that doesn't apply to this because no one's even buying. Next is the core business. And this is where we get to the major problems that are internally, where the business is at, and how much they can scale, what their addressable market is. So right here, I just want to give some clarity here, and I don't want to give reassurance, but I want to point this out. So Palantir has basically tripled from year to date. So this is when they just hit profitability down here. And these are earnings reports, by the way, quarterly earnings. And it has tripled. And now today, the company is trading between $35 billion company and $40 billion company. So when they hit profitability, this stock has been going up and appreciating for shareholders. The question is, and this leads to the ultimate problem, how much further can they scale? What is their approach? What is their plan? What specifically does the business do? And I would love to point out Palantir's financial statements. I mean, they're excellent. They really are. I mean, they have $3.3 billion in cash. Revenue was up 16% over a year. Gross profit was up 22%. That's phenomenal. Both of the, and this is kind of slowed growth now, but this is phenomenal. Operating expenses fell. That's great. Then other income, this was interesting, was negative, and now they went positive. Then the boogeyman down here of dilution, 11%. And like I said, they are going to continue to do this since it's part of their plan to scale their product and brand name across industries. So stock-based compensation may be coming down over the long term, but it's still going to be relatively high in comparison to peers. So dilution is going to be that byproduct. So this is a great illustration of the stages of a business. I believe this visual was put together by Brian Feroldi. But this chart will show exactly where Palantir currently fits on the spectrum. In our first column, for stage 1, we have the startup, which is pretty self-explanatory with its name and details. Then as the further right you go, the more mature the business gets, ending with stage 6 in decline. Many bulls believe Palantir is currently in the full-out hyper-growth stage, but that couldn't be further from the truth. None of the details align with where the company currently is at. For growth businesses, revenue growth and gross profit in the tech industry, that's typically 30% plus year over year, along with quarter over quarter. Palantir is nowhere in this arena, since it's further along in the business cycle. Palantir just passed the self-funding stage this past year, already reaching profitability, and they are now somewhere in between stage 4 and stage 5. Revenue growth isn't growing slowly. I wouldn't want to classify that as slow revenue growth at 16%. It should be classified under modestly. Then gross profit or gross margin is classified as stable. That's correct. For both Palantir's net profit margin and operating margin, which was 13 and 7%, is growing rather slowly. The one metric that does not correlate at all is the share count, which is basically the building block to our bear thesis. So now we're going to take a look at Palantir's Glassdoor reviews. And a lot of bulls kind of want to overlook this, but it's very interesting what people are saying about this company, former employees. So here you're looking at one where they're talking about the structure of the business, the management. There's just no guidance from management at all. There are some good pros in each of these, but the cons really outweigh the pros, in my opinion. This one right here, absolute hell for sales professionals. And I noticed a trend that there's a lot of reviews from the sales department, ex-employees. Um, and they're all saying the same thing, really. There's no guidance. It's just a toxic place to work. And also saying they don't approve the CEO or the business. This one here, basically saying the business is, again, leadership, not good. No organization does not approve the CEO or the business. Here is a 2-star review. Does not recommend the company. But again, it's an ex-employee from the sales department. I don't know what's going on there. It just sounds like there is no structure at all. There's no guidance for these employees. A 2-star review saying the company they approve the CEO. They do not recommend the business, and solidifying that there needs to be a leadership change. Another former employee basically saying the sales culture is awful, and in the con saying that the leadership there's no guidance at all. This just reinforces what our bear thesis is, and that there is problems going on internally. Another former employee, sales department, obviously saying it's an absolute hell, does not recommend CEO or the business. And again, in the con, no guidance. It says there's zero sales background and ignorance. A 1-star review saying that the company is a mess, referring to that there's no structure, and does not recommend CEO or the business. And then lastly, bad management. So what we've been talking about this entire time, it's either a toxic place to work, or there's just no structure or guidance from management. And these are recent reviews, by the way, up on the top, November 16th, 2023 and December 14th. These are relatively new. Then we get to our ultimate bear thesis, and that's to minor or major problems internally within Palantir. I don't want to toss around the word fraud or AI imposter, but with the combination of what we just went over, points to issues within the company, or unfortunately something more complex and bigger. The unusual resignation of their chief accounting officer was very concerning, especially how it was done and when. I often don't let these consume me, but there was no description on why it was done, and the timing right at profitability questions why. Insider selling is also one of the bigger concerns I have. When your entire management team has sold consistently for months since IPO and hasn't bought a single share on the open market, makes no sense. Especially when they are selling so much, they are actually exercising their options, letting them vest, and then dumping immediately. Not only selling their direct stakes, but the timing of the bulk of the selling done at all-time highs, then consistently continuing to sell over months. And when we looked at stock-based compensation and dilution, it's almost mathematically impossible for this company to have any more significant capital appreciation, especially at the rate they are diluting shareholders, and it being a core part of their business model. When we combine this with their employee reviews on Glassdoor, it really raises a red flag that there are issues internally with management. Now, I do realize that bad Glassdoor reviews are common for all companies, but not at the rate Palantir has them. It's nearly 20 to 30% of the reviews, with the majority talking about management and toxicity in the workplace. I also put unknown addressable market here in the context of not knowing what their current market share and realistic addressable market is. With a company of this size trading above $30 billion plus, management has really dropped the ball on conveying a clear and concise plan, approach on how they plan on becoming the top AI play of the next decade. And frankly, this lack of transparency has clearly relayed over into their internal governance, raising the red flags that there are minor or major issues internally, probably something bigger. But that is it for this video. If you enjoyed this content, Like the video and subscribe to stay up to date for future releases. We have a couple more exciting bear reports we are going to release in the coming weeks.